The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, I hope you're all doing well today. I'm just on here a couple minutes before just to do a quick sound check. So if you can hear me, please click the raise hand icon on your webinar control panel. Great, thank you so much everyone, and we will get started in just a few moments. Greetings everyone, my name is Sarah Clark and I am the Program Coordinator with CIPH. Welcome to today's Getting to the Financial Light at the End of the Tunnel, a complimentary webinar. I'm pleased to note that we have 86 sites registered across Canada for today's session. Please note that a copy of today's presentation will be made available to all attendees following the webinar, and you will have the opportunity to submit questions after the session has ended. A document outlining today's presentation was sent to you in the confirmation email for this webinar. If you need this document, it is available in the handout section of your webinar control panel. We are pleased to offer live simultaneous French translation for today's webinar. The instructions on how to operate this can be found in the handout section of your webinar control panel. If you have any questions about this or need assistance, please type your question into the question box. Today's webinar presenter is Dr. Albert D. Bates. Dr. Albert D. Bates is a principal in the Distribution Performance Project, a research group devoted to distribution issues. Al makes approximately 50 presentations each year on topics such as improving the bottom line, getting serious about profit, doing more with less, and pricing for profit. He is also the feature speaker at the University of Innovative Distribution. He has written extensively in both the professional and trade press, including the Harvard Business Review, the California Management Review, and Business Horizons. Al received his undergraduate degree from the University of Texas at Arlington and his MBA and doctorate from Indiana University. While at Indiana, he was one of the first recipients of the Ford Foundation Fellowships in Business Education. He is married and has 3 grown daughters. When he is not traveling, giving seminars, he enjoys tennis and skiing. He is not particularly good at either one. Ladies and gentlemen, please welcome Dr. Albert Bates.
Thank you, Sarah. Delighted to be with everybody today to talk about getting to the financial light at the end of the tunnel. I wish we had a happier topic. I wish we could talk about maximizing profit in a rapidly growing market. That would have been about 5 months ago, but what we're going to try to do is make the best of the situation we have and see if we can not only survive, but prosper, which I think we can. Before we get started, I have 3 quick ground rules. Number 1, you should have a handout. Actually, you must have a handout, so make sure you have that. Number 2, since we're recording this, there's not a way to facilitate Q&A during the session. However, I want you to ask any questions you have. On the cover of the handout, the 3rd line to the bottom is my email address. So just email me a question and I will answer it then confidentially, which is the best way to handle financial questions anyway, so it's just you and just me. Typically, I answer them the same day, worst case, the next day. And then finally, the most important ground rule, I'm not going to tell you what to do. I've attended a lot of webinars recently and read a lot of articles, and they all talk about, here's the 5 things you got to do to survive in today's market. Nobody knows what's going to happen. Nobody can tell you what to do. What I'm going to try to do, hopefully successfully, is give you some structure so that you can take your understanding of where we're going and facilitate the actions that you ought to take. So I'm going to give you a structure on what to do, not what to do specifically. With that said, let's jump inside the handout and go to Exhibit 1. And all the handouts are numbered in the lower left-hand corner, so you should not get lost. And I list 4 things we're going to do today. Number 1 is I'd like to outline a financial appraisal of where you stand. And all this simply means is somewhere on the absolute relaxed to absolutely panicked mode. Everybody is in that position somewhere. I want to position you. Now, I'm going to look at 2 ratios. They are critical life and death ratios. You should probably look at 100 other ratios, but I want to give you 2 that'll give you a real quick insight as to where you are and where you should be on that relaxed to panic mode. Number 2, I want to identify what I'm calling the key mistakes from the past to be avoided. And mistakes is a little strong. It's really human nature reactions. And we tend to do things in response to panics that we have. And we do the same things every time. Some of them are good. Some of them are candidly mistakes. After 9/11 in the United States, distributors made a number of actions. Some were good, some were bad. During the Great Recession and after, we made the same decisions again. Some were good, some were bad. I don't want to make the same bad decisions again. I'd like to change that if we could. So this time around, 3rd time around, let's see if we can avoid those mistakes. Number 3, I'm going to suggest an action plan to improve performance. About during the last 15 minutes of our session, I'm going to switch gears from where we are now to where we'd like to be in the future. And so I'm going to try to give you some guidelines of what you ought to do to make sure that we are successful as we can be in whatever the new normal turns out to be. And then finally, during about the last 2 minutes of the session, I'm going to identify some free software. Notice the word free, that can help you in doing some planning. Free does not mean it's lousy. No, it means that it's free and it's actually pretty good. So those are our goals, our guidelines. Let's start with the number 1 on the chart that's outlined in red on your screen now. And it says, where are we? Let's go to exhibit number 2 and put together a company. This is the typical company in your industry, according to the benchmarking survey that is done for you. You're about an $80 million company if you're typical, and coming down 2 lines, I got a gross margin of 26.5%. That is, again, the typical gross margin that we have in this industry. And down below that, I've got some expenses. I've got payroll and fringes, which is everybody's payroll, plus all the costs associated with that. So all the social costs that you pay associated with that payroll, and then all other is everything that's not payroll. Rent, utilities, depreciation, interest, bad debts, all those sorts of things. And notice that payroll and fringes is almost twice as big as everything else put together. That simply means that when we start talking about making some changes, doing better in our particular business, we're probably going to have to look at payroll. I am not going to be a slash and burn payroll person. Never have been, never will be. But we are going to say we maybe need to get a little bit more productive, understand some of the pressure points in doing that, and see where we are. Great. If I take my expenses and subtract from my gross margin, I got a bottom line of $4 million and a number left blank in your handout. So please write it down if you would, please. My bottom line is 5%. For distributors, that is a knock 'em dead, really good number. So at least going into this downturn, we started from a position of strength. If we had had problems of a pandemic during the Great Recession, it would be blood on the sidewalk, but luckily it's not. We're starting from a position of strength, and we're getting some challenges against that position of strength. So far, no need to panic. I want to now take below that and do a couple of minutes just to show how you need to look at your business. And most of you are large companies. You've already done this, but a lot of times we do it incorrectly. We need to know what are our fixed expenses and our variable expenses. If we're going to see where we are and where we're going to be in the future, absolutely essential to understand this breakout. Fixed expenses, as it now says on your screen, are those expenses that only change when action is taken. And what that simply means is if you don't make a decision, if you don't take an action, the fixed expenses are fixed once you have the budget. Now, in a downturn, what we tend to do is we tend to cut a couple of fixed expenses. One is travel. Okay, we cut that. The other is training, which bothers me because I am in training. But those are the things that we cut. But we cut them and only cut them because we took an action. They didn't cut automatically. They cut because we did something. In very sharp contrast, variable expenses change automatically. And that means is when sales go up, or worst case, sales go down, these expenses will fall right along with a sales volume. They include things like bad debts. They include commissions, which is usually a big number for most people, interest on accounts receivable, those sorts of things. I've made them arbitrarily 5% of revenue. And that's probably pretty close. I'd like you to make sure you analyze your expenses correctly. Most companies tend to overestimate what their variable expenses are. That means they think that when sales fall, they're going to get a lot of expense relief. Generally, we don't. There's more fixed expenses than we perhaps think. But for right now, in our little example, $13 million to a fixed, 5% variable. So that's our income statement. We need to also have just part of a balance sheet. And on exhibit number 3, I've got 4 items. Cash, I got $1.05 million. That's a nice hunk of cash, but you're a big company, so you need a nice hunk of cash. What we have a lot of, what we have a lifetime supply of, is accounts receivable, $12.5 million. Wow. And inventory, $17.5 million. You folks carry a lot of SKUs. You got a lot of inventory. That's the way it is. But we can't make it different, except maybe we could cut the inventory. We'll talk about that going forward. And then down at the bottom, I owe my suppliers $6 million. This is where a lot of times distributors panic and say, oh my God, I owe my suppliers $6 million and I've only got $1 million in the bank. As long as the railroad is running, it's not a problem. You owe some suppliers today, some next week, some next month. So you keep selling, you keep collecting, you keep paying. It's wonderful. It's only when the railroad slows down or comes to a screeching halt that this becomes a problem. But going into this particular situation, we had no real challenges. This was good enough. We'll see whether it's good enough in the pandemic situation. Great. All right, we got this company set up. Let's finally do something. Let's look at the first bullet point, which was what are these 2 key survival ratios? And on exhibit 4, I brilliantly have them listed. The first is a profit ratio. Okay, I have one ratio for profit and one ratio for cash flow. The profit ratio is simply the break-even point. How much of a sales decline can the firm manage without resorting to desperation measures? Desperation measures mean that we start to cut things we probably should not cut. We don't just cut travel and training. We begin to cut infrastructure. And typically what happens in a real negative situation is we cut infrastructure and later we have to add it back. Cut, add, a little dysfunctional. So what I'd like to do is say, how much of a sales hit can we take before we maybe begin to have to get into those desperation measures? That's a profit number. The cash flow ratio is one you have never calculated in your life because I invented it about 2 weeks ago. It's called the collection sensitivity ratio. How much can collections begin to lag before you have a cash problem? And what tends to happen in recessions, as you know, is we can begin to get paid a little slower. Now, we may also pay our suppliers slower to offset that, but I want to look at how big of a hit can we take on the accounts receivable side, because that's our major cash flow issue that we have before we begin to have some cash situations. So 2 ratios. As a reminder, you should also calculate 100 other ratios. These are just the 2 that give me an early warning system on where you are. All right, let's look at the first one, the break-even point. I've got 2 exhibits on that, Exhibit 5 and Exhibit 6. Exhibit 5 calculates the ratio. Exhibit 6 says, what in blazes does it mean? But we have to calculate the ratio before we can figure out what it means. to calculate the break-even point, and I've titled this, let me read the title, The Results When the Band Stops Playing. What happens when things go from wonderful to not so good? Where are we in terms of the break-even point? You need to know three things to calculate the break-even point. You need to know your gross margin percentage, which we said was 26.5%. If you do not know that, you do not have a accounting system. I need to know my fixed expenses. We're going to do it for the entire year. And it's important that we look at this on an annualized basis. So fixed expenses for the year, and then my variable expenses as percent of sales, and we calculated those. Our ratio simply says that we're going to put the fixed expenses in the numerator, 13 million two. Back in the old days, before most of you folks were born, we used to call that the nut. Okay, it's what we have to crack before we begin to generate some profit. And so I've got to cover $13,200,000 of fixed expenses. The problem in the denominator is I don't get to keep every dollar of sales revenue that I generate. The first thing that happens right out of the box, 73.5 cents go to suppliers. So I get to keep 26.5, but I've got those variables, so my denominator is 21.5. That gives me a break-even point. Oh, what an ugly number, 61 million and a lot of decimals out there, but you can see them all on your handout, 61.4, let's call it, being rounded down. Okay, what does that mean? Exhibit 6 gives us what it means. And it says if sales fell by 23.3%, we would be at break even. I put a number up here, and that number says a 20% safety factor is the goal. We're actually in the Canadian market doing much better than that goal. In the United States market, we ain't close. So you folks are doing much better as a starting point. You got more breathing room. I use 20% because generally in most recessions, that's about as bad as it gets in kind of a worst case scenario. And so you good folks are better than you need to be. It's always better to be better than better, but for right now, you're doing pretty good. So if sales goes down 23%, my fixed expenses, if I don't begin to cut, stay the same. My variable expenses go down automatically because they remain 5% of sales, and my profit goes to 0. Now, before we leave this table, very important point. We said we were looking at an annualized basis. For most distributors, January and February were pretty good months. Okay, they were actually, for most people, real good months. March was marginal, and I know in the CIPH numbers, down about 8.5%, still marginal. April was not a month to write home to mom about. I'm aware of that. It was a wipeout month. Here's where I am not telling you what to do. I'm telling you how to look at it. You got to say, is the rest of the year going to be a bunch of Aprils, or is the rest of the year going to be one more April, call it May, because we're done with that, then a couple of Marches, and then back to January and February? What do you think is going to happen? You need to decide what do you think is going to happen, and this number calculated for your particular firm will tell you to what extent do you need to panic. Every company is going to have a slightly different number. This is the typical number for typical firm, for which there is no exact thing. It's a statistical typical firm. That's where we are. You need to decide what you think is going to happen. And if you think, oh, when the year's over, we're going to be down 10, 12%, I would not panic. If you think it's going to be down 35%, you got to make some decisions. That's all it is. Let's look at cash flow. And the same situation, Exhibit 7 and 8, one Exhibit 7 sets it up. Exhibit 8 has what we need to look at. Exhibit 7 says we have a couple of things that we like to look at in measuring accounts receivable performance. The one that you always look at is the bottom one on Exhibit 7, the collection period, or the DSO, the days sales outstanding. Okay, you look at that all the time, probably monthly, maybe weekly, maybe daily, I don't know, but you look at it all the time. When the folks who do your benchmarking analysis calculate this, they have to first calculate the top ratio, which you probably have never looked at. It's too dull to look at. It's called collections per day. How much money is received each day from the fact that we have sold things on credit and not yet collected? And according to your handout, The credit sales are 80 million. I made up all of your sales. Divided by 365 days, every day $219,000 comes in the door. Some comes in by check, some comes in electronically. Some may be a guy brings a attaché case over full of $100 bills. I don't know, but it's 219,000. We take that 219,000 and say, hey, we are owed in the bottom 12.5 million bucks. 219,000 comes in every day. Therefore, it would take us 57 days to collect the entire 12.5. That's all it says. Here's what's important. We're going to take the 219,000 in the top, the collections per day, and ask ourselves, how much slower can we get paid before we begin to think about life? That takes us to exhibit number 8, the collection sensitivity ratio. We're going to take our cash on hand, which is $1,050,000. We're going to divide by that 219,000, which is 1 day. And we're going to determine, you'll have to write this down, we can be paid 4.8 days slower before we are running out of cash. Now, as I said earlier, we can pay the supplier slower. That's no big deal there. We also probably have a line of credit. But let me tell you, banks are notorious. They give you lines of credit and they take them away. So I'm a little concerned about this ratio. 4.8 days, and you're collecting in 57 days. You got about an 8.5% breathing room there, if you will. That's 4.8 divided by 57. I'd like to see this number be, again, closer to 20%. So it's kind of a magic number. I'd like to see this ratio in the 10 to 12 day range if I could. I can't make it different. It is what it is. You got to learn where you are for yourself and figure out what it means. But the conclusion I draw is from a profit perspective, we're in pretty darn good shape. From a collections perspective, maybe we're a little bit on the tight side. And again, you got to calculate that number for yourself. All right, take a deep breath. Try not to hyperventilate. And let's go to exhibit number 9. Exhibit number 9 says, nobody is exactly typical. So what I've done in exhibit 9 is I've broken out 3 what I'm calling volume sensitivity groups, okay? Or excuse me, profit sensitivity groups. They are typical, high profit, and low profit. Typical is our firm right smack dab in the middle. We said it had about a 5% bottom line, and it's got a 23.3% movement from where we are now to break even. That's pretty good. There's a high profit group in your survey. Holy cow, 10% bottom line. That is phenomenal, and I salute those people. And they've got, look at the right-hand side, 46.5% breathing room. Wow. That's, again, no company in the U.S. would be close to that. This is a sensational set of numbers, and these are our top firms in terms of profitability. Now, we do not calculate low profit in the survey, but I like to go diddle with the data. So in data diddling, I look at the low profit. They got about a 2% bottom line and only about a 10% gap between where we are now and break even. I want you to take an oath. And that oath is when we come out of this for the future, and we seem to have a problem about every 10 years, 9/11, at least in the United States, but it also bothered Canada, the Great Recession, and now the pandemic, about every 10 years we have an issue. The next time we have an issue, okay, I'll be in the grave, but don't worry about that. The next time we have an issue, I want you to say, gee, I've got better than a 5% bottom line. Maybe I've got a 7, 8, maybe even 10% bottom line. I want you to take an oath you're going to be high profit. And if you do that, we'll not have to have a session like this the next time there is a recession. Good. So that says where we are. 2 ratios you must calculate. Go back and calculate those ratios and calculate 100 others. Let's turn our attention now to the second thing that was on my exhibit number 1. You go to exhibit 10 while I go back to exhibit 1 and reminisce. I want to identify the key mistakes or the key human nature things that we do whenever things get tight. And again, I'm labeling mistakes. It's gut reactions to a recession, really what they are. To do that, I need to set it up. And my setup is in Exhibit 10. Exhibit 10 looks at, again, the typical firm, and the title is The Relative Impact of Improvements in the CPVs. The CPVs are my term for the critical profit variables, the things that really drive profitability for distribution businesses. There are 5 of them: sales, gross margin, expenses, inventory, and accounts receivable. They're the big 5. And what we're going to do is we're going to cross the horizontal axis, say, what if we improved any one of the big 5 by itself? Okay, by itself. What if we improved it 5%, 10, 15, 20? 20 would be knocking them dead. But let's assume maybe in the 5 or 10 range, there's a chance to improve. And then we're going to ask ourselves, what does it do to my PBT? On the vertical axis, the PBT, if you recall, is 5%. Let's start at the bottom. We've got 2 lines that are almost on top of each other. There's a yellow line with little triangles as accounts receivable. There's a line with little squares that is purple, I think, on your screen out there, which is inventory. And what it says is, let's go over to the 10% improvement line. We go up and it says, hey, it's not going to drive PBT at all. Let's talk about this. I'm assuming when you cut inventory or accounts receivable by 10%, you will not lose any sales. That is a big assumption, which is making inventory and accounts receivable look as good as they can. But if we're going to cut inventory or accounts receivable by 10%, it would be nice if we got a payout. Well, the payout you get is inventory and accounts receivable are gigantic drivers of cash flow, incredible drivers of cash flow, huge drivers of cash flow. I'll stop being dramatic. They're big drivers of cash flow. They are minuscule drivers of profitability. And I'll prove this in about 2 seconds. So if we're trying to do 2 things, we're trying to worry about profit and we're trying to worry about cash flow. When I worry about profit, I do not go to inventory and accounts receivable. I go to something else. The something else is, next line up is sales. It looks like an aquamarine line to me, but I'm colorblind, so I'm going to assume that's what it is. And it's a nice line. It's not as steep as the 2 above it, however, because what it says is when you increase your sales, oh, the variable expenses go up automatically. So it's a nice improvement, but it's not as gigantic as maybe we would like or maybe we would think. It's still good. Above that is the expense line. And notice at the 10% point, a 10% cut in expenses drives a higher PBT than does a 10% increase in sales. That's got to be wrong. No, that's right. Trust me on this, if you would. Now, there's a couple of issues. Number one, cutting expenses does not motivate employees. Okay, they don't just jump up and down and say, "Oh man, today I want to cut expenses." It also says nothing about market share, and sales outgains expense control on both market share and employee enthusiasm. However, I'm going to stick to this because it's true. Expense control has a bigger impact on profit than does the same commensurate increase in sales. We need to address that. We'll talk about it going forward. Finally, the highest line is gross margin. Gross margin, those funny little X's up there, that's the biggest drivers. So let's take these 5 lines, kind of think about them still, and ask ourselves, what are we doing that's incorrect when we have a recession? The first thing we do that's incorrect is we take that gross margin line, which is the steepest line that we have, and we mess it up. That's on Exhibit 11. Exhibit 11 is an exhibit I have used with you folks in presentations before, but I'm going to use it again because it's a moldy oldie and it's really nice. The increase in unit sales required to exactly offset a price reduction. What that means to you in English, or perhaps in French, is that every dot on that line, I make $4 million. Notice the line is curved. Everywhere on that line, I make $4 million. Then across the horizontal axis, I'm going to cut my price by 1%, 2%, all the way to 5%. And then I'm going to ask myself, how much do I have to increase unit sales to keep profit at 4 million? Let's just go out to the 5% line. Let your finger go out on your handout, go up to the little dot, go back over the left, and you should be somewhere around 30%. So it says, hey, I cut my price 5%. I got to do 30% more physical volume, unit volume. which means 30% more physical volume plus 5% price cut, about 35% more dollar volume to keep making the same profit. This graph tells me you cannot make it up with volume. Let me first tell you a story, and then I'll talk about the implications of this graph. This story is one I've told in all the webinars I've done recently, and it involves a guy who ran a lunch wagon, as we call it in the United States, a lunch wagon outside an office complex in Denver. And every day, people loved his food, and he would sell about 100 lunches, just knocked them dead. Great thing, had a wonderful life. We had a pandemic, which you may have heard about, and nobody went to work anymore except a skeleton crew, and every day he started selling about 15 lunches rather than 100. So he said, hey, I got a brilliant idea. I'll cut my price. And he cut his price and he sold 15 lunches. When people aren't buying, they aren't buying. Now, I don't know if they're going to start buying again. I do not think, however, if they're not buying, they're not buying. They may be, however, if they're large, sophisticated customers, going to buy now when you cut the price and then not have to buy it later when you raise it back up. I don't know. I will also tell you Exhibit 11 says this is assuming we cut price across the board. And nobody cuts price across, well, actually, some idiots cut price across the board, but most of us who are halfway intelligent, which are members of your association, do not cut price across the board. However, going to Exhibit 12, maybe your stupid competitors do. And what Exhibit 12 tries to say is, what do we have to do to offset that price reduction? Let's assume that competitors have cut the price 20%. Excuse me, 5%. Let me get my numbers straight. They have cut 5%. Forgive me. And we're going to say, what do we do? Well, we have A, B, C, and D items. Everybody does. A items, which are about 60% of your revenue, those are, I'll use the word which I should cut my tongue out after I do, those are commodities. That means if you're too high priced on them, people think you are gouging them on everything. You're kind of forced to the party to cut on the A items. And notice I put there minus 5%. B items are basic items, pretty good items, about 20%. C's are kind of specialty items, 15%. And D's are really slow selling. We carry them only because occasionally a customer needs them, and we buy them. What this graph says is that if you cut 5% on the A items because you're forced to by competition, to keep your gross margin right where it currently is, which I believe is 26.5%, you would have to raise the B items by 5% and raise the C items 6.7 and raise the D items 20%. Now, I've argued long and hard in past sessions that you can raise those D items a lot and nobody's going to care. I think that's doable. I don't have to do it, but I still think it's doable, even though you have to do it and not me. The B's and C's, 5 and 6.7, that may be heavy lifting. That may be really tough, but at least you got an idea about what the nature of the challenge tends to be. All right. First thing we do is we cut the price. Shouldn't do it. The second thing we do is we worry maybe too much accounts receivable. I'm not sure you can worry too much about accounts receivable, but I want to go to Exhibit 13 and suggest perhaps we do with some serious implications. Exhibit 13 says, what does it mean to collect faster? If you recall, we had on line 1 something called collections per day. That was how much money came in every day. And we said it took us 57 days to collect everything. So that's how we got to 12.5 million. 219 times 57, I got 12.5 million bucks of accounts receivable. And then we say, hey, let's cut that accounts receivable 5 days because people are going to start dragging us. Let's get on top of this. If we cut it 5 days, we're going to collect in 52 days. Let's make the assumption that we do not lose any sales by cutting the collection period. Let's make that assumption. I don't think it's a good assumption, but let's make it. That means the same 219, same sales, same collections per day, times 52 days is 11,000,004. That means we could reduce AR by 1,000,001. that means we could raise cash by $1.1 million. And if I recall, we had $1 million of cash. We've now doubled our cash. I think I said earlier that inventory and accounts receivable had a what? Big impact on cash. This is a big impact on cash. Well, what's the implication for profit? Now, everybody knows that there's an inventory carrying cost. There's also an accounts receivable carrying cost. We don't look at it very often, but there is, in fact, an accounts receivable carrying cost. It's interest, it's bad debts, it's the cost of hounding people. Right now, in today's environment, it's probably no more than 4%, but I plug in 8% on the assumption interest rates would someday come back to normal. And 8% says times $1 million reduction, that's 88,000 more profit. Well, gee, 88,000 more profit, and we made what, $4 million? That's a puny increase on profit. I'll reiterate what I said brilliantly earlier. Big impact on cash, small impact on profit. However, let's address this issue of maybe when we cut collections, we sell less. And let's go to Exhibit 14 and plug in another version of the break-even point and figure out what would happen if we cut our accounts receivable collection days and we had a sales decline. How big of a sales decline would we need to wipe out what we just made? I have to go over this quickly, and I apologize. It's the way we are. We're a slave to the clock. I've got some numbers. I've got 13.2 of fixed expenses. That's what we currently have. Plus, I added back in the numerator $4 million of profit. It was bingo. Subtracting out 88 that we just made, and I got the same denominator, which says that sales would have to fall to 79.5 million, or here's the number to write down in your notebook. It's a crucial number, minus 0.5%. What that says in English is the following, that if we cut 5 days and it caused sales to fall by 0.5%, we would make less profit than we did before. You've now got to analyze the trade-off between cash and profit. Again, I'm going to tell you how to do things, not what to do. And I don't know if you should cut collections, not collect collections, worry about profit, not worry about profit, but you at least have got this ratio and you could calculate what this relationship is for your business and begin to make those decisions that are realistic. Now, the final thing that we do in a recession that is a mistake is we tend to stop buying. And I said I was not going to tell you what to do. I lied. I'm now going to tell you what to do on Exhibit 15 and 16. If you have a stop buying mandate, you are a fool. Okay? And I know that's a blatant statement to make, but it's one of the biggest challenges that we have in a down market. Exhibit 15 says we've tried to do 2 things in inventory, and they're in opposite directions. One is in the middle column, provide customer service. Have things when people want them. Yes, that's a good idea. The second is provide financial stability, and that is not be up to our ears in inventory. Those are in conflict. Okay? They really are. Okay? If I look at how easy it is to measure them, the service level or the fill rate is really hard to measure, almost impossible to measure. The inventory turnover is very easy to measure. I happen to own a copy of Excel. That's how forward-thinking I am. I can calculate inventory turnover to 64 decimal places. Here's the problem. When you have a ratio that's difficult to measure and a ratio that's easy to measure, we always move towards the easy to measure ratio, which means that inventory turnover takes up a lot more space than does service level to fill rate. Well, going down to the third line, the implication of service level is you need more inventory. And I believe the mantra there right below it is, you've heard every salesman say this, can't sell apples from an empty cart. The financial stability is, let's have less inventory. And the financial guys have their own mantra, cash is king. There's not many of them in sales, not many of them in finance as there are in sales, but they have more bass in their voice because they can calculate inventory turnover to 64 decimal places. What tends to happen in a down market is we stop buying. When we stop buying, the only thing we run out of are the good things that people want to buy. Your service level dies. Now, I'm going to give you something that you do not believe. It's in exhibit number 16. And what it is that you do not believe is customers do not buy from you because you're good looking. Really? I thought they did. No, they don't buy from you because you're good looking. They buy from you for some reasons that are listed in exhibit number 16, and they are listed in order of importance. This research has been done every blooming time after time in every line of trade, and it comes to the same conclusion every time. The overwhelming thing that people want is they want you to have a good fill rate. They want you to have it when they need it. Number two, they want you to have depth of assortment. They want you to have a lot of things that they need, because even though they say they're going to go out and check on the internet and find the lowest price and shop 48 different people, it's a lot easier to buy everything from one supplier if you could always have it. Number three, they want speed of delivery, because they really wanted it 2 days ago and forgot to order it, and they need it now. They would like it to be accurate. They would like you to actually send them what they ordered. They're weird like that. They actually want what they order. And then if you do all that, pricing is nice. I want you to not issue a stop buying order. I want you to control the inventory. I didn't say that. I want you to control the inventory, but I don't want you to run out of the things that people want to buy, because if you do, that is a kiss of death in a down market. All righty. So we said, don't cut the price unless you have to, but you got idiot competitors and you probably have to. Make sure you look at the trade-off between accounts receivable collection and sales, and don't issue any stop buying edicts. Manage the inventory. Don't go into gut reaction. All righty. You go please forward to exhibit number 17 while I reminisce once again on exhibit 1. The third thing we said we would do with about our last 15 or so minutes in our discussion is we would suggest an action plan to improve performance. Remember, we took an oath that the next time we have a problem 10 years from now, you're going to be an incredibly high profit distributor, and you're not going to even bat an eye when we have an economic problem. How do we do that? Well, we got to look at payroll as a starter. Exhibit number 17 is U.S. data for all of distribution. Okay, I don't have that access to your data to do this for year over year. I have access to U.S. data going back a long ways. This is aggregate data for U.S. distributors. I'd be amazed if Canada is not reasonably close to this. And the title of this exhibit is, What's Wrong with This Picture? And I've just put a trend line up. And that trend line is, hey, wow, payroll as percent of sales tends to be going north rather than south. I guess actually in terms of bad, it's going south rather than north. It's going up. This despite the fact that we have been incredibly productive. We have put in technology all over the place. We've developed new and better brilliant systems. We've changed out our inventory systems, our accounts receivable systems, our operating systems. We've done everything there is to do, and payroll as a percent of sales is still going up. There's a problem, and that problem is technology and productivity is not going to save the day. We need to do something else, and I've got a couple of something else's to do that we will look at. But first, we have to look at where do we spend our payroll dollars. Exhibit number 18 has payroll as a percent of sales in the middle column and percent of payroll in the last column. So what we have is we have got our percent of sales numbers here, and this is 12.5%, which is raw payroll numbers, no fringes on here. Okay, so I've ignored the fact that you have some bonuses and you got some other things. Those are not equally distributed across your business. So instead of using the 14% number, I've gone back to the raw payroll numbers and just plugged them in. So it's 12.5% before fringes, 14 after fringes. Let's look at the 12.5. Okay. Owners and officers are about 1.2% of sales according to survey. I am stupid, but I'm not this stupid. I'm not going to suggest that we cut owners and officers' salaries. Okay, I'm a little dumb, not stupid. The next one down, Salesforce, 6% of sales. Wow. Operations, warehouse and delivery, 3.4% of sales, and all other backroom, office, those sorts of things, credit collections, 1.9. On the right-hand side, I've got percent of payroll, and I'm going to put a number up there. Salesforce is half of your payroll. That's not bad because the payroll goes to sales, and the Salesforce has got a tough job, and they got to do it. But I'm going to tell you, you're spending more on payroll than you should. Okay, that is a large percent of total payroll compared to other distribution industries north and south of the border. Now, I've got two things I'm going to whine on. Number one is we need to have the right people in the sales force. The problem that we have in sales is in the North American economy, we need more salespeople than we have people who have selling skills. That means we have to hire some people who really should be accountants, and we call them salespeople. I want you to make sure you've got the right people. I want you to go back and make sure every individual is operating effectively, and you say you've done that. Yeah, but you've not done it as well as you should. So I've seen some of your salespeople. I need to make sure I've got them up to speed. I might also need a new sales model. I keep hearing consultants say we need a new sales model. I don't even know what that means, but I think it means that we bring technology to bear to say, do we need a salesperson in every situation? Can we use technology to augment or maybe even offset that salesperson? I need to get control of this number. Well, I've got, in addition to go and making sure that we've got the right salespeople and we are using technology properly in sales, I've got a couple other things that we need to do. Exhibit 19, Enhanced Order Economics. And it's subtitled in the title of the handout, The Battle for Sales Without Payroll Expense. I want to generate more sales without more payroll, or at least without an equal amount of payroll. That means when I raise sales 5%, I'd like payroll to go up 1%. I want to begin to get augmentation there. There are two things that drive it, and there are two things that you need to measure, monitor, and control all the time. Number one is lines per order. I know I gave it 1 star. It's important, but it gets only 1 star. I need to put more lines on every order. And this is the classic, would you like fries with that work? I need to get more effective add-on selling. I also need to expand the product line. So I do, in fact, have one-stop shopping. And I got to educate my customers all the time about what you sell, because some customers don't know what you sell and they buy from somebody else because they don't know what you sell. That's important. It's 1 star. What is even more important and gets 2 stars is the average line extension, or the average order line value. I can do selective price increases here and there, particularly on D items, which I talked about earlier. And we could also change the order cycle, that maybe everybody doesn't have to buy quite as frequently as they do. We could help them plan ahead. I know you sell to contractors, and I know contractors planning ahead is an oxymoron. I'm aware of that. We ought to work with them. That's a way to get more sales without an increase in payroll expenses. Here's a little sideline. If you cannot measure lines per order, and if you cannot measure average order line value, you have no chance of improving them. You need to measure that and know it by customer, know it by Salesforce, by sales personnel, know it by territory, know it by branch, know it every way you can know it. You got to have a system that does that. The last thing I have on the payroll side is we got to come look at the customer set. And on exhibit number 20, I'm going to talk about customer profitability. I'm not going to talk about how profitable they are. I'm talking about how profitable are they for you. And we can divide them into 4 categories. High profit, those customers that in fact are high profit. They generate a lot of profit for you. Good profit, yeah, we do okay. Some profit, marginal, and unprofitable, you lose money servicing them. These are not my numbers. These are numbers that people who are smarter than me use, but they get them every single time they do the analysis. And what it says is somewhere around 15% of your customers give you the dollar equivalent of all your profit. That means they generate $4 million of profit. That's a number. There's about another 15% of your customers that give you 35% of your profit, but you never see it because you give it away later. There's about a third of your customers that are, we're calling some profit, okay? They're marginal, but they do okay. And then there's a group, only about a third of your customers, nothing to worry about, which costs you 45% of your profit, or $1.8 million if you're making $4 million. So you could have been at $5.8 million, but because of these, you got $1.8 million taken away, and you end up back at $4 million. There's a real tendency to say, let's fire those customers. I'm going to put on the screen, and you should memorize and write down, only fire a few. In most distribution businesses, there are about 2% of your customers that you should probably fire. Okay, these are customers that know they cause you to lose money, and they don't care they cause you to lose money. They're probably also jerks that your sales force would not mind kissing goodbye. The best way to fire them is just keep raising the prices. After you get rid of the 2%, though, you still got 35 minus 2 is 33% of your customers you got to work with. We got to help them be more profitable for you. And it gets back more than anything else to how frequent do they order. We got to work with them to plan ahead. All right, that's my bag of tricks. Let's spend the last 2 or 3 minutes going to exhibit number 21. While I go back to exhibit 1 for the last time, identify some free software. I've got some software for you that would help you. It is Excel based. They're all Excel files. At the top of that, it says free planning help. Notice that is my website, distperf.com. You go to the programs tab, which I think is the first tab. You then scroll down to where it says hands-on tools, and lo and behold, up pops about 5 or 6 Excel. Look at right now. What if sales fall by 35%? What is the implication? What if I cut my price 2%? What is the implication? And you can do all sorts of permutations together. Now, your CFO already has this file, except his file requires 412 data entry points. Mine requires about 10. It is designed for top management to be able to figure this out quickly without having to spend 6 months doing the analysis. There's price cutting economics. That's an Excel file. If you remember that little curve that was little graph that was curved, that every dot was 4 million, you can calculate that for your company. Can I? Yes. There's business valuation. I hope we ignore this. I hope you're not selling. But if you're a buyer, you may want to do it. But let me warn you, given where we are right now, this file is useless because we're not in normal times. Okay? Understanding the CPVs. You may also require that we had a graph, okay, that had 5 lines on it. Inventory, accounts receivable at the bottom, then sales, then expenses, then gross margin. You can reconstruct that line for you. You can reconstruct that graph. It's a good thing to have. And then finally, there's something called profit first planning. I would encourage you to go to my website and find those. Before we move forward, one little bad information. When you go there and download any of those Excel files, it will pop up and say, this file is password protected. You must send Uncle Al a password request. I will send you the passwords. I will never send you another email in my life. Never. I do not email saying, I'm a wonderful human being, buy my services. Okay? For one, I'm not a wonderful human being, and 2, I don't sell that way. So I will send you the passwords. The only reason I do this is I want to know how many people actually get off the schneid and do something. The final one of these is called Profit First Planning, and I want to spend 30 seconds, if I could, on exhibit number 22 and then 23 talking about this. Exhibit 22 says the way that we plan is we start with sales, because that's the top line of the income statement. We then calculate our gross margin. We then calculate our expenses. And here's the rub. Profit is whatever is left over after we stop subtracting. We start with sales, subtract cost of goods to get gross margin, subtract expenses, and we get profit. It's a residual. I would like you to say, why don't we start with profit as the first thing we plan? This is called profit first planning. It is extremely controversial, unbelievably controversial. People say you cannot plan profit till you know sales, and my argument is au contraire. That was for the folks in Quebec. au contraire, that we can in fact start with profit and then ask ourselves, how much sales do we have to generate to produce that profit? How much margin do we need to produce that profit? How much do we have to control expenses to produce that profit? It's actually a great way to plan. It's just controversial, and it's opposite of everything we've done for the last 85 years. And I'm going to argue the last 85 years has been pretty good, but it could be better. Let me spin one exhibit, and I will do no more than a minute on exhibit 23, which is an example from Profit First Planning. This is what the template looks like. At the very top, it says, hey, goal number one, plan profit first. First thing you should do, skip the text. Go to the box below that. It says, hey, you told me your current profit was $500,000 pre-tax. Your current ROA is 5%. And then down below that, there's a little box. You can put a number in. What do I want for profit next year? And I plugged in, I want to make $600,000. And it says, hey, that's a 20% change. That will take your ROA, assuming your assets don't go up, to 6%. And then down at the bottom, something called Profit Guru comment. I've had my brain surgically removed and put into this Excel file. And it says, hey, puppy, that's a small change in ROA. In a typical 1 year, you should be able to drive 2 to 3 more points. So it leads you along on every factor, sales, expenses, gross margin, and especially profit. It's a nice template. You don't have to use it, but I'll send you the password. Before we finish, and I will finish, I promise, in 2 minutes, I've written a brilliant book. It's called Breaking Down the Profit Barriers in Distribution. It's a book that every one of your managers should read. So all I'm asking is each one of you buy 50 copies. It's available on Amazon. It's available on Barnes & Noble. It's available on the hated Amazon, I should point out, and Barnes & Noble. All righty, let's review. And I'll spend 1 minute reviewing. We said about 3 or 4 things. Number one, we said there are 2 ratios you must calculate. Your break-even point, absolutely must know how much of a sales decline can I take. Number 2, the collection sensitivity ratio. How much can collections back up before I begin to have a cash flow problem? Number 2, we said there were mistakes that we always make. We cut the price. It's just human nature. Let's try to avoid that to the extent we can. We tend to get a little tight on collections, which maybe we need to, but let's offset that with the implication for profit. And number 3, do not issue any stop buying edicts. We also said going forward, we were going to be a high profit distributor. We needed to get control of payroll, particularly sales payroll, because you spend an inordinate amount of money on sales payroll. You got stuff that has to be sold, I'm aware of that, but you spend too much. We said we also needed to get control of order economics, lines per order, average order line value. And we also said that you needed to get control of customers and begin to manage them. I know managing customers is a tough way to think about it, but working with customers so that you make more money and they make more money, because if they write orders every blasted day, it's costing them money as well. And then finally, we said there's some free software for you out there. I hope you go out and make more money because you're nice folks and you deserve to make more. I enjoyed being with you. Thank you very much.
Thank you so much, Al, and thank you so much, everyone, for attending today. As Al stated at the beginning of the presentation, if you have any questions, please feel free to send him an email. And please look forward to our survey and a copy of the recording, which will be sent to you either later today or tomorrow. If you have any other questions or concerns, please email us at info@ciph.com. And as always, stay safe and have a wonderful day, everyone.